Hey everyone, Michael Rosmer here. Welcome back. Day 5, our final day of our investing mini-series. Now, we've started off by giving you a foundation to your investing in order to do a couple things. One is give you the best risk-weighted return with security in terms of what to do first, and then be able to decrease your risk by managing how your portfolio is laid out from having that volatility that might force you to sell at a loss, therefore effectively boosting your rate of return in a very real sense, even though it might not seem like it on paper. Then we talked a little bit about what it is you should invest in and how come. So productive assets, and discussed what those were and how to pick them out, etc., how to get the best rate of return. Then we talked about getting security and being able to minimize your downside. Again, remember the key here is increased risk-weighted rate of return, our real rate of return after factoring in risk, which most people don't pay attention to. Most people are paying attention to that average or sticker price, which isn't the key here. The key is, in the big picture, we're going to have that risk. How much do we really end up with at the end of the day? And that's what we talked about. It's how to minimize the downside portion of it. Then we talked a little bit about how to really supercharge those returns using the basic concept that Warren Buffett uses, value investing, and how to, again, simultaneously decrease our risk, increase our return for those who want to get more deep into it. But I've talked to you a little bit about how, again, so the idea here is there's a lot of people who can go out and they'll roll the dice on investing. I've seen people do it over and over and over again. It's a common thing with traders. They think, oh, you know, I could hit it big, so I'm going to go and invest. And I was just talking to somebody about it the other day. They approached me and they said, hey, you know, there's this friend of mine, they have an app, they're saying it's going to go big. And I'm like, 90 to 95% chance, it's 100% loss for investors. Which means that just to break even, based on a 95% chance of 100% loss, they need to get more than 20 times return on their investment just to break even on a risk-weighted basis. They might get lucky, but our goal is not to get lucky. Getting lucky we can't count on. You can't count on winning the lottery. You can't count on, I don't know, marrying somebody rich. I guess that one you have a little bit more control over. But the goal is to have something that's predictable, that's going to work over time to get us to our goals, all right? And that's where we're talking about simultaneously decreasing risk and increasing return. And the two most powerful ways that you can do that, something that has zero risk associated with it, but boosts your return relative to everybody else, is number one, we talked about reducing our fees, okay? If you don't have to pay fees, then that's money back in your pocket, and there's no risk in order to have that, okay? So you could get 2, sometimes 3% a year more return, which is going to compound over time, versus somebody else who's paying high fees. The second one is taxes. Taxes are really significant. If you think about, let's say that you're paying a 40% tax rate, and you could somehow end up in a 20% tax rate, so that would be as an example in the US, if you're talking about regular taxes versus qualified dividends or capital gains, all of a sudden, let's say it's on $100,000, you're saving yourself $20,000. Or if you're talking about, say, on an annual basis, say you're getting a dividend distribution instead of an interest distribution, you're talking about, and say it was 10% on, so you're getting $10,000 a year, you're talking about saving yourself $2,000 a year, every year. What can you do with $2,000? You can probably go on a decent vacation for that. If that compounds for you, then over the course of 10 years, that's really going to add up. You're talking about a pretty major difference. Again, go back to our rule of 72 and look at, okay, if I can all of a sudden get, let's say it's $10,000 or $8,000 instead of $6,000, what does that do for how long it takes us to double? It takes 12 years for it to double based on 6% and only 9 based on 8%. So if you double it a few times, you get to, after 24 years, you've got literally double the amount of money based on that slight change, okay? Which is pretty, it's huge. It's a very, very major difference. So, or actually, those numbers are off. I apologize. We're talking about 18 years, it would be 2/3. But anyway, it's still a large amount of money, right? It's doubled twice in the one case, and then it's doubled 3 times, or sorry, it's taken, my numbers are way off, but it would be 36 years, sorry, it would have doubled 4 times versus 3 times. Okay, so those are the actual numbers. But anyway, regardless, the whole point is that slight difference in rate of return has resulted in a very significant real increase over the lifetime of that investment, like double the amount of money in 36 years, based on that slight change. Okay, that's only one thing we can do. Now there's lots of different tax systems all over the world, and because of that there's different tax incentive vehicles and all this kind of stuff. So I'm going to try and cover what I can for you in a broad sense, in a way that's kind of universal and fundamental, and I'll mention a few of the details for particular countries, but you really need to look at what it is for your country. And if you're in a place like Singapore, you've got a great tax system that's going to work very favorably in your case for investing. If you're in, say, the US, not so much, and there's everything in between. So before that, I'm going to talk just briefly about, now there's three ways you can reduce taxes. Okay, the one is you can decrease your taxable income. That's primarily done through business expenses. And you could invest through businesses. This would be common, say, in the case of real estate, where you're going to either write off your interest, your, say, depreciation on chattel, maintenance costs, things like this. So that can help to boost your return on a tax basis. Okay. The second thing that you can do is you can decrease your tax rate, which could come from either moving somewhere to a different country or moving the income to a different country if possible, which is sometimes the case, sometimes not. It could also be getting capital gains or dividend as opposed to interest income, or in some cases there might be exempt income. So any of those things could be useful. And the last one is deferral. Deferral, I really underestimated how powerful it is, but it's very, very significant. And I'm going to go through with you a little bit how significant. So there's a guy named Tony Robbins. Some of you might have heard of him. He has a presentation he shows, and when you saw this, I went home and I did the numbers. I was like, what? That can't be the case. He said if you took $1 and you doubled it each year for 20 years, after 20 years, how much would you have? And so you go from 1 to 2 to 4 to 8 to 16 to 32 to 64 to 128 to 256 to 512 to 1028, on and on and on, right? After 20 years, how much money do you have? You'd have over $1 million. It's like, I think, $1,040,000 or something like that, but approximately $1 million, okay? Now, what if you got taxed at a rate of, I think it was 33% each year? So instead of going from 1 to 2, you go 1 to 2, but you get taxed on that growth, okay? So that $1 is actually just 67 cents. So instead, at the end of year 2, you have $1.67 instead of, or at the end of year 1, I guess, after the first doubling period, you go from, instead of having 1 to 2, you go 1 to 1.67. So over the course of 20 years, how much has that 33% tax rate hurt you? How much, instead of getting $1 million, how much do you have? You're going to have less, of course. The question is, how much less? Is it going to be 33% less? So you're going to go from $1 million to $670,000? Nope. Nope, much, much less than that. So you say, okay, well, I think maybe $400,000. No, less. $200,000. No, less. $100,000. Less. It's $28,000. Literally, that 33% tax rate compounded over time has cost you $1 million. Okay? Now, if you deferred, and what deferral means is you don't pay any tax all the way along, and then at the end you pay a big tax bill. Okay? So based on deferral, that 33%, so even if you got taxed at the end, you're gonna lose 33% of a little over $1 million. So you're gonna have, it's approximately $680,000 versus $28,000. So deferral versus not deferral in that example cost you about $650,000 over 20 years. Okay, that's a big. 28,000 versus 680, whatever. Now, the problem I have with that example is nobody's going to double their money year over year like that, and also nobody's going to start with $1. So I put together some numbers to show, based on a fairly realistic scenario, what the effect would be. And so here's the numbers. We're starting based on let's see here, about $250,000 invested. So this is fairly reasonable. A lot of people would have that in retirement savings or something by midlife, right? It's not an unreasonable number to have. And we're assuming that the interest rate on it, or the rate of growth, is 10% a year, okay, which is a little aggressive. Most people are not going to get 10% a year on average. Using the information here, there's a reasonable chance that you could. If you get really good, it's very reasonable for somebody who cares about investing to do better than 10% a year, okay? And the other thing is we're assuming that it's 40% tax payable each year or deferred, okay? So if you have to pay the tax every year, then after 10 years, okay, the amount that you would have is, actually we're going to go to 20 years, okay? So after 20 years, your $250,000 growing 10% a year but getting taxed as it grows is going to equal $801,783.87. Okay, so that's pretty good, right? It's more than tripled. It's pretty decent growth. Let's look at the alternative. If you were taxed at the end, okay, so you deferred that income, and you just got taxed at the normal rate, the same 40% rate, at the end, you're going to end up paying you're going to get $1.109 million. So in other words, deferral has saved you $300,000, which as a percentage is more than 33%, more than a third, right? With $300,000 as a percentage of, that's a $307,000 difference, which as a percentage of 800,000 is, I don't know, probably 35-40%, something like that. So literally, that's just the effect of deferral. You haven't done any different investment. The investment is identical. The time frame is identical. The amount of money is identical. Everything is the same. But you ended up, if you and a peer both did this, one of you ends up with almost 40% more money. That's pretty impressive. It's a significant amount, right? So, let's talk about how we can do these things and give you what tips there are. We're going to go into primarily tax rates and deferral, okay? So, save on taxes. Let's talk first about deferral strategies. So, how do you defer? Well, the beautiful thing is that we've already talked a little bit, and this is one of the reasons that we went with the vehicles we did based on that. Remember at the beginning, I went through that strategy with you. We were talking about what are the two things that you buy early on. Whole life insurance, dividend participating whole life insurance policy, and principal residence. Now, depending on the country you're in, I'm in Canada, the growth of value in your principal residence is tax-free. So right off the bat, boom, you're ahead of the game by doing that. So compared to everything else, compared to deferring, if it's tax-free, then effectively it's deferred in this case. Why is that? Because you're paying after-tax dollars. Okay, so you've earned the money, you pay the tax on it, then it's going to grow, and when you sell, you're not going to get taxed at all on it. So great. That's the equivalent of deferral, okay? And I'll show you how that works in just a minute. So that's number one. And then the same is true with dividend participating whole life insurance policies. So I've looked out at quite a few of these policies, etc. And if you get a good policy over a very long period of time, call it 100 years or something, the lifetime of the policy until age 100, which is kind of how they price these, then you're typically looking at a rate of return of about 5 to 5.5%, okay, per year. And you might say, well, that's not a very good return, Michael. I mean, it's a lot lower than your 10%. And that's fair, except that this is tax-free returns. So if you were to get taxed at 40% on that 10% rate of return, how much more income, how much is that worth? And so very frequently you need to get 9 or 10% in a normally taxable vehicle to get the equivalent. Make sense? So it's actually a pretty good rate of return when you consider the tax advantages, I guess what I'm saying. So deferral. And so number one we've got here is we've got principal residence. And again, depending on where you are in the world, that the tax treatment is going to be different. Okay, so you've got to look into it. But very frequently, there's some sort of incentive. In the U.S., it's not an unlimited amount, but you can get a certain amount of growth that's not taxable. And you have something called a 1031 exchange, which is where you can sell and buy a new property. And so that gives you some sort of, it's not the same quality of deferral, and we'll talk about that in just a minute. Okay? So these two things, life insurance and again, there's fancy rules around life insurance. There's something called MTAR, and there's all these different ways that life insurance is regulated and what you're allowed to do with it. So we're not going to get into the specifics because, again, it varies by the part of the world that you're in, but just know that this is a great vehicle for that reason, okay? As well as it's guaranteed, so it's contractually guaranteed, it's protected from creditors, you can borrow against it, on and on and on, right? So those are the first two ways of deferring. What's the next way of deferring? This is through some sort of a tax favorable vehicle, okay? And so as an example, in the US, we've got a 401k, okay? In Canada, we have a TFSA and an RRSP. And these are typically retirement vehicles, okay? So generally speaking, in a lot of these countries, the UK, I forget what theirs is called, but different parts of the world, there are special vehicles set up to help people plan for retirement. And the way that this works is one of two ways, okay? Either when you put the money in at the beginning, so with an RRSP, this is the way that it goes, then that decreases your taxable income today, so you don't pay the tax on that income now, but you do pay it at the end, okay? A TFSA, you pay the tax now, but you don't pay it at the end. So a TFSA is really the same as the life insurance policy. An RRSP is slightly different, but has the same. Ultimately, so long as your tax rate is the same at the beginning and the end, it works out identically. There's no difference in the net amount of money, and there's arguments for and against why you should use one first versus the other and all this kind of stuff. I wouldn't really worry about that at this stage. There's some benefit to having something that you can get money out of, so that's useful. So as an example, in Canada, TFSA, you can pull the money out. The contribution limits tend to be lower depending on what your income is, and but consider that, hey, listen, the ability to get money out could be useful. On the other hand, and especially depending on your tax brackets, okay? So you really have to sit down with an accountant or somebody to figure out for your individual situation. But the important thing is these are always better than just raw investing, assuming that there's no fees, okay? So fees aside, just investing straight up is worse because of tax than investing through one of these vehicles, okay? So you can't always invest in the same things, and there's lots of other complications, but let's just go with that for now. So this is kind of the next quality, or actually it's an equivalent quality to these. So these three here are your main quality of tax deferral vehicles, okay? What else can you do though? Well, the next thing you can do is you can buy something and just hold it. So if you buy a stock, assuming it isn't paying dividends, it's just all capital appreciation, then when you sell it, years and years later, which could be 20 years, 30 years, 50 years, it doesn't matter. When you sell it, you pay tax, but you didn't pay tax on all that growth all along. Now, why is it not as good as these? Because you still had to pay the tax up front, okay? So you put in after-tax dollars, so let's say that, just use an example, say you had $100,000, it was fully taxable, let's say at 40%, so now you have $60,000 to invest. It grows tax-free, at the end you get taxed. Okay, if you were to go with one of these, then you either put in your $60,000 and it grows, but then it doesn't get taxed at the end, or in the case of some of them, such as an RRSP, you don't have to pay the tax now, it grows and you get taxed at the end, okay? So regardless, one way or another, these are all vehicles that are useful to you. And ideally you start with these ones, but otherwise you can go into its long-term hold assets, okay? And this would typically be stocks/funds or real estate, okay? Those are all ways that you can, and you should just be thinking about this because usually there's limits on how much you can put into here, and like I said in the earlier cases, rates of return, okay? So you're gonna max out, now what do? Well, now you start looking at long-term hold, and this is Warren Buffett has like a deferred tax bill of billions because he never sells anything, and it compounds his rate of return purely because of that, okay? So that's pretty well what it is you can do. There is one, well, we'll move it into the next one. So these are the basic vehicles that you're looking at, okay? You're going to look at your principal residence, life insurance, some sort of retirement plan that's tax deferred, and failing all those, you want a long-term hold, okay? Now, am I saying you should hold long-term? No. You should never, okay, this is a mistake that a lot of people make. A lot of people make investment decisions based on tax. Dumb idea. Don't ever do that, okay? You make the best investment decision and then figure out how to do it in the most tax efficient way, not the other way around. So as an example, we'll talk in a minute about a particular tax vehicle that's sometimes more efficient depending on the country that you're in, and people will go and do that because they have a high tax bill and it ends up messing them up. It's not a good way to go. Or somebody will say, oh, I want to turn around and, I don't want to sell this. It's up right now. The market's really high. I don't want to sell it because I'm going to have to pay tax. Well, you know what? If it drops, you're going to be way worse off most of the time. So just don't think about that. Don't think about the tax when thinking, like, buy and sell good investments based on good investment logic. If you think worst case scenario, this is like a really bad, this is the worst it could go. Enron's at the peak, and you go, I don't want to sell because I might have to pay tax. What happened there? You lost everything, right? You want to make the best investment decision, then figure out how to deal with the taxes in the most efficient way possible. There will be people who will disagree with me. They'll say, okay, well, you want to realize losses by selling. And yeah, at a certain level, you can do that kind of tax planning. At the level that we're talking about, don't bother. Don't think that way. Generally speaking, I wouldn't go with that kind of thinking. There is a case where, yes, that can be the case, but that's really more complicated than we need to get here. What we're doing is we're giving you the 80-20 rule. What's the 20% we can give you that's going to give you 80% of the results? This is going to get you ahead of most people. And it's going to, each of these little things I'm telling you is going to boost you a little bit, which is going to add up to a lot, okay? So tax rates. Depending on where you are, different types of assets will be taxed at different rates. And this, again, there's a little bit of planning that comes into here between these two, okay? Usually, you're talking about 3 different types of tax rates, okay? You've got what I would call interest income, which might not be from just interest. It could be, as an example, from what's called non-qualified capital gains in the U.S., so capital gains that aren't taxed at a favorable rate. It's come from working income. It's your full tax rate, okay? So we're going to call it interest income, but understand that it's broader than that, okay? The second is dividend. And again, depending on where you are, that might be taxed at a more favorable rate. I interviewed somebody today talking about Puerto Rico and cases where you could get dividends tax-free as a Puerto Rican resident, things like this. Again, depending on where you are in the world, Singapore, again, you've got a better tax system. But very frequently, dividends are taxed at a lower rate. And why is that? It's very simple. Here, I'll explain it to you quickly. Because when you go out, a business has already paid tax on that money. So there would be a double tax if you paid the full tax afterwards. Does that make sense? So the business earns the income. It earns $1 million. It pays 40% tax. There's $60,000 left. Well, if now they pay you, and you pay 40% tax, that got doubled up. So in a lot of places, what you'll do is you'll get some sort of a favorable tax rate. In the U.S., you can get these qualified dividends. At this moment, as I recall, it's 20%. In Canada, it's a more complex formula. It depends where you are. Some places, they don't tax dividends at all because it's been taxed at the corporate level. Sometimes it's the opposite. In Estonia, they don't tax anything until it gets distributed. So bottom line is, pay attention to, can you get a favorable tax rate through dividends? And so I'll give you an example of where that's relevant. Let's say that you are looking at buying a bond, say a GIC, a guaranteed investment certificate from a bank, versus the bank stock. The bank stocks very frequently pay pretty high dividends. So 2 to 5%, let's call it, okay? Very frequently in that 3 or 4, 5% range. Again, sometimes a little higher, sometimes a little lower, but let's just approximate. That's going to be a dividend, which is generally taxed at a lower rate. Versus, if I go and I buy the GIC, and it's fully taxable, then I might be the same rate, right? Okay, let's say, it's just for the sake of argument, say it was a 4% rate, right? 4% dividend, 4% interest rate. Same returns in that cases. Now, the bank stock has a higher upside, and there's a whole bunch of reasons why I like bank stocks, as I've mentioned earlier. But that's not to say that they're always a good idea. It's not, we're not giving investment advice of buying anything specific. But the whole point is that a bank is relatively safe, generally speaking, especially in, say, a Canadian bank, as I've talked about. And anyway, all that aside, if we just look at dividends versus interest, interest is going to be taxed frequently at twice the rate. So let's say it was at 40% instead of 20%. Okay, so what does that mean? Well, 40% is going to be 1.6% off of my 4%, so I'm down to 2.4% real rate of return, right? Versus the dividend. Now the dividend might not be as consistent, then again it could also go up, this sort of thing, but it's taxed at only 20%, which is 0.8%, so I'm at 3.2%. So instead of getting a 2.4% real rate of return, I'm getting a 3.2% real rate of return. Significant difference, right? So that's an example of paying attention to this. Now, if you have a tax-deferred vehicle and you have to choose, say you only have so much room, then you're generally going to want to put your interest income into the tax-deferred vehicles because you get that favorable tax treatment off the dividends. Okay. The last one is capital gains, and I should mention there are some cases where there'll be like interest-free or tax-free bonds. So sometimes buying government bonds and various types, etc., can get zero tax on them. And so that's worth considering when you're looking at comparing investments side to side. Capital gains. Capital gains are for basically long-term holds, okay? And so this is usually if you hold a stock over a certain period of time, if you own a property past a certain length of time, etc., you'll frequently get somewhere around a 50% decrease in the tax rate. So why do we like capital gains better than dividends? Dividends get paid out every year, so they're taxed every year. Capital gains grow tax-free. We only pay the tax at the end. So we have not only a favorable tax rate, we also have deferral. Okay, so that's better. There's a vehicle I'm going to talk just briefly about on this subject, which is they're called flow-through shares. And at least in Canada, I don't know the rules everywhere, but basically what it does is a flow-through share allows you to take losses from the company, and it changes what's called the adjusted cost basis of your investment. And then what happens is when you get a return, it comes as basically it converts your working income into capital gain income. So it's supposed to be an effective tax strategy. Again, I'm bringing this up specifically because I see a lot of people go and say, oh, look, this is this great investment. There's a reason they do that for you. Okay, usually it's saying like oil and gas exploration, something like this. That's usually because it's a risky investment. And I've just seen so many people who lose all their money in it or lose a whole bunch of money, and then it doesn't matter. It doesn't matter what the tax savings were because you lost your money. All right? Do not lose money. Warren Buffett, rule number 1. Rule number 2, don't forget rule number 1. Okay? So, generally speaking, stay away from flow-through shares and all that kind of stuff. Maybe there's the odd occasion where it might pay off, but on a risk-weighted basis across the averages, it's just not worth paying attention to. Stay away from it. Okay? So this is the two ways that you're going to do it. You're going to reduce your tax rates, and you're going to defer. And hopefully you can see how our plan, right, when I was telling you, okay, what are we going to invest in? We're going to invest in productive assets. Where do those fall? Well, principal residence and long-term hold with capital gains rates. So kind of what I've laid out for you should give you a more efficient tax strategy on its own, okay? If you go and try to do fancy things, and you're flipping, and you're doing this, that, and the other thing, you're doing trading income, or you're doing options or something like that, then you have to worry about all this other tax stuff, and it becomes much more complex, and that's going to eat into your rate of return. So this gives you a pretty good framework, all right? This is a pretty solid, like you can go out, and these are things you can easily apply, all right, day to day. Will these give you a 20% a year average rate of return? Probably not, okay? Will they boost you relative to people who aren't using these things? Yes, absolutely, okay? This is going to give you a major advantage, and that major advantage compounded is an enormous, enormous advantage. That's what we're here for, okay? That being said, if you have any sizable amount of money, let's say that you have $250,000 or more that you're investing, then getting a few extra percent is worth a lot to you. Okay? So 2% on $250,000 is $5,000 a year. 2%, not a big difference, right? Not hard to get an extra 2%. To get an extra 5%, right? You're talking about now, what is that? $12,500 extra per year. And again, that's going to compound and compound and compound. So over time, it's going to add up to a lot more. And it just grows the better you can get the returns. So If that is something of interest to you, if you want to look and say, all right, you know what, it's nice that I'm going to end up 3-4% a year ahead of my peers by using these strategies. But you know what, I really want to take this to the furthest level. Maybe I've got $1 million to invest. That's 5% gain, $50,000 a year. That's a big gain that's going to compound for you, right? If you're interested in that, we have programs and training for you to go and do that. It goes very, very deep into analysis of looking at growth, so growth investing and value investing, the two strategies that are what really boost those returns on a risk-weighted basis. And they're not easy, all right? It's comprehensive, but some people enjoy it. I personally enjoy it. I like figuring out what makes the markets move, what's driving prices, etc., learning to pick out market inefficiencies, paying attention to when to buy and when to sell, and that's what we do. We talk about, okay, what should you buy and when? Like, how do you analyze and determine that so that you can do it yourself? You can look at any investment, you can analyze it, you can say yes or no, and is the price right? Are we at a place where it's a low price, so we get that added bonus? Okay, what about when should we get out? So when do we get in, when do we get out, what do we get? And in excruciating detail, going through, we'll talk about what does Warren Buffett look at? What do people like Ray Dalio and Howard Marks and all these different people, Phil Fisher, etc., look at? And so if you're interested, we put together, it's the monster training program that's going to give you a ton of value. And so I would invite you to go and sign up for that. And the other thing that goes along those lines is the action classes, all right? The action classes are really, what I've put together is I've said, okay, what is it that people really need to succeed and get ahead? They need great education, yes, but they also need some sort of like community and accountability to help them to apply it. And more importantly, they need some instruction so they can, when they have questions, they can come on a weekly basis, Rhythm Creates Results, and get those questions answered. Or go onto the forums and get it answered right away, okay? And what else do they need? They need a community of people that can support them, to both encourage them, help to source deals, help to have cost savings, like all these different things you can do together with other people that immediately save you money and help you to make a lot more money. And normally, how is that available? That's normally available in the form of, you could pay for a big mastermind that might cost $50,000 to $250,000 a year. You might be able to pay for some sort of coaching, and coaching programs are very frequently, I know somebody who does coaching, it's $16,000 for a stock coaching program. It might be, $2,000 to $15,000 a month, depending on the coaching program. So we've taken all of this and we've combined it into a model that you get that huge value for $249 a month, which is nothing, right? Very easy if you're just mirroring the trades that we're doing or the investments to get that rate of return, depending on how much money you have. Like, there's lots of different ways you're going to be able to work with other people. So when you're buying vehicles frequently, you can save money through the community. You can save money on jewelry, on tires, on all these different things that we've, as a community, come up with ways of saving you money. You get that support. You get those people who are going to keep you on track and help you out. That's all available. And I don't know of any other program that offers that kind of interactive value, that kind of engagement, the curriculum, the community, all together for nearly even remotely that close value. So I really would encourage you to go and sign up for that. I mean, how great would it be, right? If you could boost your rate of return by, a few percent a year and you've got a decent amount of money, how great would that? That'd be amazing, right? If you could just go and save money on your regular expenses through the community, you're going to go and buy a vehicle and you can save a few $1,000s on it. That'd be fantastic, wouldn't it? If you could go and you could, source out some great deals and collaborate with some people, if you stayed on track because of the fact that you had people there every week that you could come to, what would that be worth? That would be amazing, right? It's hard to say. Hard to put a value on some of these intangible factors of working with people. If you can get your questions answered rather than, going and paying somebody $500 an hour or something who often doesn't know the answers, isn't kind of in the game with all this, what's that worth? It's worth a lot. I mean, on a weekly basis, $500 an hour, let's say you had to do that. Even if you had to do it, twice a month, it's $1,000 a month, right? So huge, huge value that we've compressed for you. We work very, very hard. You can go and sign up. There's a money-back guarantee. If you're having struggles with it, if you don't feel you're getting the ROI, contact me. I'm going to make sure that you get that ROI, and otherwise there's no risk. I mean, you can get your money back. It's no big deal. So I really encourage you, go and sign up for the Richucation action classes, take our courses, sign up if that's something of interest to you. And we'll look forward to seeing you very, very soon. Thanks for being with us here. Go and like our Facebook page, join, participate in the community. Tell us your feedback. Tell us how this program was for you. And we'll talk to you very, very soon.